Today I'm with Bruce Newberry, who is a business friend, tax accountant, CPA qualified, founder of Life Balance Accounting Professionals, tax accountant for a number of clients that might be listening to this. Important part of business is having a really good advisory board around you and good friends in business, and Bruce is definitely one of those for me. And today we were having a conversation that arose with a client's circumstance. In particular, that client had built an investment property and they were wanting to know how that tax was going to be treated because during a build process, it's not necessarily rented out until right at the end. However, you're incurring the costs throughout that process for a client. So would you mind sharing, Bruce, with our listeners, what happens in that circumstance?
Well, Emma, that's a great question. Due to a case from a number of years ago known as Steele's case, the tax office actually lost that case, and it was based around the fact that a taxpayer had purchased a block of land with the intent of building something, in her case it was a motel, which she would then in the future rent out and derive income from. So the question was, well, if I'm building something, can I claim the interest on the land as I'm building it as a tax deduction? I haven't rented it out yet, and as you know, the general principle is that you cannot deduct something until you've derived assessable income from it. But in this case, Mrs. Steele won her case, and the tax office were forced to concede that in the circumstances that you are going to build something, then provided that you have the intent of renting it out, the interest is going to be tax deductible. It's going to be tax deductible prior to it being rented out. Now the great news is, Emma, also the holding costs associated with that construction, for instance, rates and taxes and similar type costs, will also be tax deductible prior to the property being available for rent.
Oh, great. So if we were right on the cusp of the financial year where we've got a client who maybe just finishing the property and we're something around, June 28, 29, 30, and we haven't got a tenant in, we can assume then to be prepared to have those deductions ready to claim in that year. Would you also claim the depreciation as well? Or would you claim that in the next year?
I would hold the depreciation because technically, in my view, the property's probably not finished. And therefore I would be tending to hold back the depreciation. But certainly the costs incurred in relation to interest and holding costs should be claimed prior to the rental starting.
And what about another cost that a lot of the time clients overlook, which is the borrowing cost? So it's not actually the interest that's being charged, it's things like maybe mortgage insurance, valuation fees, bank fees, those types of fees. How do those costs get deducted?
Well, they're also holding costs. They are basically all totaled together. All the borrowing costs are totaled and amortised over a 5-year period. But it's also, Emma, important that they are prorated. So for instance, a borrowing cost might have only been incurred for a few short month period up to the date that you're claiming it, and therefore you would prorata it from the number of days that it was purchased or was incurred. So therefore, for instance, if you've incurred a cost on the 1st of January, which I think might be 183 days in a year, I'll stand corrected on that, someone might know, you would then prorata 1/5 of the total borrowing cost for 183 days. So that would be more like 1/10 in that case.
Yeah. And that's why we have Bruce, the numbers man, good at working out all of these numbers. So what's important for a client to know is that they need to just be able to have all that information available when they're looking at a purchase and being able to make sure they've got that in that year. So is there some key documentation that you would suggest that they have prepared for you?
It's very, very important to know, obviously, how much the interest was. I would suggest that you provide your accountant full things like contracts. That's money to ascertain when the actual contract was initially started, and that becomes important down the track for capital gains tax calculations. The loan documentation will often have drawdowns and fees and charges which an accountant can determine how to treat from a tax deductible point of view. Of course, the interest is ascertained from that as well. Diverging, if you've bought a property that hasn't been constructed, of course, then you'll need your settlement statement and your contract will be vital.
Okay, great. Thank you very much for sharing with us today, Bruce.
Thank you, Emma.
Valuable information.